Hello again, everyone. This is Brian. I want to take a closer look at one of the advantages of an IUL over a Roth. Now, this is a huge area of debate. I don't want to go into the whole debate right now because it is quite a religious experience to get into it, but right now we're just going to look at one teeny aspect of the difference, and you can start making your own conclusions. The previous two videos I have out will help clarify some of the difference, but I'm breaking this down really small so you can really understand one of the advantages of locking in a return versus not locking in a return. Okay, listen, the Roth is a great product. There's no ifs, ands, or buts about it. The only advantage that the Roth has over the IRA is the tax advantage. Okay, but the IUL also has the same tax advantage. So both the IUL and the Roth have tax advantages that you cannot contest. They're amazing. So on the level of taxes, they're equal. But it's when you're growing that money from, say, age 25 to age 60 or whatever, how is that ride? How much risk are you taking? All right, so that's what I want to really make sure you truly understand. Roths and IRAs are good products, but they're always at the market's whims, which is not good. So how much risk are you taking that you don't even know about? Like I said, 2008, people lost 40% of their assets, maybe more. 2001, 2002, 2003, there was no market gains for these people and slight market losses. So their projected returns were so low, there's no way they can make what they thought they were going to make. So we have to really break this down, okay? So even though the Roth is great, it's primarily tied to the market. It means there's just too much risk and there's no downside protection. When building a nest egg, one definitely needs to take some risk, especially if you're younger and you're dollar cost averaging, which you should all be doing. But is there a way to reduce the risk and lock in all those earned gains? Let's compare. Year one, if you're an ILU investor, Investor A invests $1,000 on January 1st, 2017 in the S&P 500. These are not actual returns. This is just an academic example. Well, let's see what happens. The S&P goes up 10% for the year, ending on December 31st, 2017. The investor's account will be credited with $1,070 at 3 p.m.'s market close. So that $1,070 is locked in forever. No losses in any following years will ever take away that year's gains. Never. You made 10% that year, your account will always have that locked in forever and forever. So beginning the next year, which is January 1st, one day later, the account value will be credited with $1,070. Okay, but let's see what happens the next year. What if the market doesn't go up? It actually might go down. In 2018, the ILU investor still has, at the end of 2018, $1,070. So that means at the beginning of 2019, he still has, or she still has, what they had at the end of 2017 and didn't lose any money because they locked in that 2017 gain. In my opinion, that's not a bad deal considering the risky market went down a whopping 10%. This is a case where zero is definitely your hero. Let's look at the Roth scenario. Year one of the Roth, same situation. Investor B invests $1,000 in the S&P 500, but this time the S&P goes down. It goes up 10% for the year, so B's account has the same $1,070 on January 31st of 2017. But remember, the market went down, so what happened? This number lost 10%, which means they only get to keep 90% of what this number is. So it went down 10%. They actually lost money, and they only have $963. But remember, 2 full years went by. So 2017, they made good money. 2018, they lost money. So they're 2 years into this game, and they actually have less money than what they started with. Why? Because B wasn't locked in. Roths do not lock in your gains. Every dollar you have is always exposed to the same market risk. Why would you do that? That doesn't make any sense to me. if you had a gain of 10%, wouldn't you want to lock that in? It's like playing going to Vegas and playing a game of poker. You bring $1,000 to the table, you make $500. What you should do, everyone will tell you, put that $500 that you made back in your pocket. Okay, you have it. So play with the house's money. In this case, the Roth is keeping everything at the mercy of the market gods. So in fact, B actually has less money than 2 years ago. So B's account will need to stay in the market longer and try to make up for lost time. Staying in the market means being in harm's way longer. I hope this is making sense to you. You're seeing the main tiny little difference between how the IUL captures and locks in the gains, where the Roth and the IRA and 403Bs, they do not lock in any gains. So let's conclude. To grow your wealth, we know you have to be in the stock market. And here's some numbers I saw. In the last 40 years, the S&P returned on average 7.7 per year. That's the last 40 years from I think 2017. But remember, these are not actual returns, they're average returns. And I spoke before in a previous video about the difference between actual and averages, which are about 1% or a little more. So that's 7.7. In my opinion, it's not great, but it's very good and way better than a CD or a bond. Remember, you can't grow money in a CD that just keeps pace with inflation. You're preserving your money, but you're not beating inflation. In our early years, we need to be exposed to the stock market. Both the IUL and the Roth are invested in the same vehicle, S&P 500. The IUL locks in gains, the Roth doesn't. Wouldn't you rather lessen your risk with an IUL when swimming in the stock market waters? I mean, do you want to go to bed every night worrying what's going to happen if the market crashes, if there's a geopolitical event? Who God knows what's going to happen. No one knows. There's no crystal balls for us to read in. So how do you want to ride the next 30 years that you're saving your money for retirement? I don't want to be thinking about this every day. I want to enjoy life too. But I do know I got to be in the market. An IUL won't make money in a down market. But while you're risking your money in the market, it won't lose it for the investors either. No price tag to put on that peace of mind, my friends. That's all for today. I hope this proved informative and invaluable to you. I'll see you next time looking at some more of these differences between the Roth and the IUL.